Yes, much welcome to a class where I'll be looking on accounting upon the death of a partner. May I say that upon the death of a partner, the old partnership is dissolved and a new one must be formed. At that point, goodwill may be recognized or the asset and liabilities could be revalued, and each of these items must be accounted for with a view of determining how much is due to the deceased partner. It is also very important to note that the amount payable to the deceased partner executive or the amount is payable to the deceased partner executive or the next of kin. So this is where we are trying to say that or to look on what treatment are done maybe upon when there is a death of a partner if there was an existing partner. And we say that there are some, maybe there might be some goodwill that was realized by the business, that goodwill should be shared, and the partner who is have died should share. Another aspect is about revaluation that we looked on. This is where we revalue their asset and liabilities to the market price or the market that they can they can we value them to the with the market price, and maybe we can have them appreciating or depreciating, and even the death or the dying partner or the partner that have already died should have to share if it was a profit or a loss on the valuation or what might follow maybe after revaluing all the asset and liabilities. To understand this more, I would wish to have an example, one or two, so that we can understand more. The first example is on these three partners, partner A, B, and C. We are told that they are partners sharing profit and loss in the ratio 2:1 respectively. The balance sheet as at 31st December 2019 looked like this. That we hand this is a balance sheet. Let's start to look on the items on the debit side. That is property and equipment. They were valued at, or they were at 5,000. Furniture was at 64,500. Inventories was at 61,000. Debtors was at 34,500, and bank was at 10,000. Let's look on the items on the credit side of the balance sheet. Creditors was at 45,000. Bank payable was 15,000, and capital balances of A was 85,000, of B was 90,000, and of C was 70,000. And the balancing figure was 305,000, as you can see. We have some additional information which is very important to note, especially when dealing with these within a accounting or within an accounting problem. You have to be so keen on the additional information. You have been told that A died on 1st January 2020. And the goodwill was valued at 105,000. That is the second something to note. And there was an agreement that was made that in order to be able to pay executive of A, B and C agreed to introduce fresh capital into the business such that their capital account balances would be in the ratio 1:1. Remember that the ratio of they have agreed that they have to introduce some new capital, and the ratio will be 1:1. That is B and C, the ones that are still alive to continue the partnership. And that that ratio of 1:1 will be the new profit sharing ratio. So we are required to prepare capital account for partners showing how much is payable to the executives of A, and B, the new balance sheet. Let's try to approach that question. As you can see now, this is the format of the capital account, and we automatically have now what should we do before filling these figures that you can see here? We have, first of all, to this aspect of that you have been told that A died on 1st January, yes, goodwill was valued at 105,000. Remember, these 105,000 should be shared by all partners, including the one that have died, that is A. And to share, we'll share using the profit sharing ratio, that is 2:1. So he will get 2/4 times 105,000, that is 52,500. B will have to get a quartile 1/4 times 1/5,000, that is 26,250. C will get 1/4 times 1/5,000, that is 26,250. I think that point is at home. Another thing to consider is writing off the goodwill. We say that when we want to write off a goodwill, we write off using using the remaining partners. That is, we want to write that goodwill off, and they agree that the profit sharing ratio will be 1:1. So we'll have 1/2 times 105,000, which is 52,500 for B, and for Z is a half times 105,000, that is 52,500. That is how we have to know about writing off the goodwill. So after writing off the goodwill, you realize that the balance, to the capital account, let's start on the credit side. And on the credit side of the capital account, you can see the balance brought down. This was the initial balances of A, B, and C. That is the capital balances. A had 85,000, B had 90,000, and C had 70,000. I think that is very clear from the question. Goodwill now, this is something that we have done. We have written, or we have subdivided the goodwill of 105,000 among the three, and we have agreed that A will get a share of 52,500, B will get a share of 26,250, and C will get a share of 26,250. This amount should hit the credit side of the capital account. That is, we credit them. A 52,500, B 26,250, and C 26,250. So what should we do before we proceed? You realize that now A is have died, so there is nothing else remaining for A. So we have to sum up what is due to A, or to executive of A. That is 85,000 plus 52,000, that is 107,000. So let's now move together to the debit side of the capital account. To the debit side of the capital account, we've agreed that we written off the goodwill using the profit sharing ratio of the remaining partners. That is, B will be sharing 52,500 and C will be sharing 52,500. That is in the ratio of 1:1. But another thing that we should reckon on the debit side of the capital account is about the amount that is payable to the executive of A, and the amount that we've summed up, that is 1,750. This is the amount that will be payable to executive of A, and it should hit the debit side of the capital account. Now, since we have these home balances, we need to balance. But before balancing off, there is an aspect that have been brought in, that they agreed that they should introduce a new capital. So the question is, how much will they introduce? But the amount that will introduce is simply we'll be looking on the amount that is that we first of all to look and consider the total amount of capital required, so that we can share it among the two, so that we can see the deficit that they should introduce. I think I've been understood. We realize that we are liable of settling A, B, and C are liable of settling 107,500 to A. But remember, we have first of all to consider the aspect of the bank. We first of all use what is in bank to settle the amount. Then the remaining should be shared or should be contributed using some other ways. So when this one that's 500, you subtract 10,000. That is on the bank account. So we are remaining with 127,500. So that is, like I've said, better that we've less the available cash in the bank, that is of 10,000. Another aspect that we should look is the balances of B and the balances of C. how are we going to get these balances? Is just looking onto the credit side of the capital account. You want the balances of B is 90,000 plus 26,000, and balances of C is 70,000 plus 26,250. For B is 90,000 plus 26,250, and for C is 70,000 plus 26,250. So after you had, then you should subtract the amount that is written off to B and the amount that is written off to C. That is, you subtract 52,500 from each of them. And in simply, you realize the balances of B is 63,750 and balances of C is 43,750. Now, this is the amount that they have as their capital balances. So, and they want their capital balance to be in the ratio of 1:1. Now, the total capital for the partnership. So this partnership, we have to know now to sum the total capital that is required for this partnership. Remember, they should take care of the 127,500 for A. Then we had with their capital, that is with their capital of 63,750 and 43,750. The total capital is amounting to 235,000, as you can see in my working. From there, the second question is now, what amount will A bear and what amount will B bear and what amount will C bear? And the answer is very simple. They'll bear according to the new profit sharing ratio, that is 1:1. Now, half of 235,000 is 117,500, and half of 235 to C is 117,500. Remember now, this is the amount that should be carried down on the debit side of the capital account, and this is the amount that should be brought down in case of another year of partnership. Let's see how we treat it. So let's consider the debit side. On the debit side of the capital account, this amount of 117,000, we reckon it as balance carried down, or the capital balance. You can see here we have 117,500 to B and 117,500 to C. From there, you balance off, and the difference should be the amount that will be introduced into the bank by B and C, respectively. So as you can see in the balances of, so let's start by balancing on the debit side of capital account. You balance the figures of A, it is balancing at 107,500, and on the credit side is also balancing at 107,500. To B, we earn on the debit side of the capital account, we earned 52,500 plus that 117,500. It is totaling up to 170,000. But on the debit side, on the credit side, we have only 90,000 plus 20,250. So you realize B is required to introduce a fresh capital of 53,750. Concerning C, the amount on the debit side of the capital account is totaling 270,000, yet on the credit side of the capital account, we have only 70,000 and 26,250. So C is required to introduce a fresh capital of 73,750, and their balances, and their total balances is as follows. On both sides is balancing at 107,500, B is balancing at 170,000, and C is balancing at 170,000. I think that point is at home. Let's proceed now to the new balance sheet. You realize that there is no change on the property and equipment. It is still 135,000, furniture is still 64,500, inventory is still 61,000, debtors is still standing at 34,500. That is on the leave alone about the bank. I'll be explaining what have happened to the bank. But even before leaving it alone, you realize accounts to bank, we earned 10,000. this is the amount that was on the bank previously. Remember, this amount have not yet been settled. No wonder now we are still recording it. They have not yet been paid to A. So we hand this the amount because B was required to introduce fresh capital of 53,700 investor, we hand it, and C was to introduce 73,700 investor, we hand, and the sum is 137,500 to the bank. Let's go on the credit side of the balance sheet. You realize that the creditors still remaining at 45,000, accounts payable remaining at 15,000, and the account payable to A executive. Remember, this is a special liability because it have not yet been settled. So it is still at 107,500. Capital account of B, this is the amount that I told you that this is the amount that these are the balancing figures, the amount that we have carried down to the capital account is the amount that is the new capital, the fresh capital of B and C. That's of 117,500 to B and to C. And the balancing figure on both sides is 432,500, as you can see. I think that's all with that question. Follow slowly by slowly, and I believe that you'll have to catch on